Welcome back to Smart Stock Sam, the channel where we cut through the noise and get straight to what actually matters for your portfolio. And today, we are diving into a story so wild, so contradictory, that it almost puzzled me when I first looked at it. We are talking about a company that just posted its fastest revenue growth since going public, nearly quadrupled its net income, and demolished every single analyst estimate on the street, and then watched its stock fall the very same night. If you clicked on this video wondering whether Palantir is about to explode higher or whether this is the absolute peak before a brutal collapse, buckle up. We are breaking down every layer of this earnings report, the breathtaking highs, the hidden danger signals, and the one international metric the bears are screaming about. By the end, you will know exactly what the smart money is watching, where the key levels are, and what needs to happen for this stock to make a real sustained move. Let us get into it. What we witnessed with Palantir's first quarter 2026 results is something I genuinely do not see very often, a fundamental anomaly. When a company reports 85% year-over-year revenue growth and brings in $1,630 million in a single quarter, the textbook expectation is that the stock rockets. You beat, you raise, you go up. Palantir did all three at an elite level. Net income came in at over $870 million, staggering profitability. And yet, shares spiked toward $151 and then retreated sharply back to $142. The stock is still sitting nearly 20% below its January highs of $182. So the very first question you have to ask is, could a company ever perform this well and still disappoint the market? Apparently, yes. When your valuation bakes in near-flawless execution indefinitely into the future, even a record-breaking quarter can feel like falling short of the dream. But Palantir was not just fighting its own inflated valuation, it was fighting the entire macro environment simultaneously. Here is something the headlines did not fully capture. Palantir did not report in a peaceful market. On May 4th, the very same day the earnings print dropped, a geopolitical shock in the Strait of Hormuz sent the Dow Jones Industrial Average crashing over 550 points in a single session. Every high-growth technology name got dragged down, and Palantir was not immune. But there is a second, arguably more dangerous force pressing on the stock right now. Analysts are calling it the SaaSpocalypse. The fear is spreading fast that large language models from companies like OpenAI and Anthropic are going to hollow out the traditional enterprise software business model entirely. When you are trading at 110 times to 150 times forward earnings, any credible whisper that your competitive moat is being undercut by cheaper artificial intelligence alternatives is enough to trigger a panic. Could Palantir actually be dethroned by an open-source model in the next 12 months? Almost certainly not, but fear does not need to be rational to move stock prices. Yet before we let fear dominate the narrative, we need to look honestly at what the actual first quarter data shows, because by almost every measurable standard, this was an undeniable top-tier win. Let me give you the headline numbers first. $1,630 million in revenue, comfortably ahead of the consensus estimate of $1,540 million. GAAP earnings per share came in at 34 cents, a jaw-dropping jump from just 8 cents in the same quarter 1 year earlier. That is a more than 300% increase in per-share earnings in a single year. But the real showstopper? The United States market. For the first time in the company's public history, domestic growth crossed the 100% threshold. United States commercial revenue exploded by 133%. United States government revenue grew 84%. The AIP flywheel, Palantir's artificial intelligence platform, is no longer just a cool demo for boardrooms. It is a massive, compounding revenue generator, and the numbers prove it conclusively. The question is whether this domestic dominance is a sign of strength or whether it is masking a critical vulnerability growing quietly beneath the surface. This is where things get uncomfortable, And I want you to pay close attention because this is the exact data point that the bears are using to justify every single negative call on this stock right now. The growth inside the United States is breathtaking. We just established that. But when you zoom out and look at the full global picture, a deeply lopsided pattern emerges. United States commercial grew 133%. United States government grew 84%, partly driven by the Department of Defense doubling its usage of the Maven Smart System targeting platform. Those numbers are extraordinary. Now look at international commercial. International commercial grew 8%. 8, not 80. 8. That is not a rounding error. That is a fundamental divergence. Could Palantir seriously be a globally transformational artificial intelligence company if it cannot replicate its domestic playbook in Europe or Asia with any real urgency? The bulls will say it is just a timing issue, that international is the next unlocked wave of growth. The bears say it reveals a structural ceiling on the total addressable market that the most aggressive growth models simply have not accounted for. Both arguments deserve serious weight. But whatever side of that debate you land on, the efficiency of what Palantir is doing inside the United States right now is, without exaggeration, almost unmatched in the entire software industry. Here is a metric that separates elite software businesses from the rest of the field. It is called the Rule of 40, and the concept is straightforward. Take your revenue growth rate, add your profit margin, and if the combined number exceeds 40, you have a healthy, high-quality software company. Most solid SaaS businesses hover somewhere between 40 and 60 on this scale. Palantir scored 145. Let that settle in. They combined 85% revenue growth with a 60% adjusted operating margin. Achieving that combination at a $1.6 billion quarterly run rate is a statistical rarity in the software world. It tells you that Palantir has genuine pricing power, that their customers are not pushing back on cost, and that their internal cost discipline is extremely tight. They are becoming a cash flow machine in real time. And yet, incredibly, even this historically strong efficiency score was not enough to fully satisfy Wall Street, because the market found three very specific things it did not like inside this earnings report. The first issue is what traders are calling the commercial whisper miss. While 133% growth sounds spectacular, and it is, the United States commercial revenue line hit $595 million, just slightly below the $605 million whisper number that the most aggressive analysts had been modeling. On Wall Street, when you are priced for perfection, a $10 million miss versus an unofficial whisper number can be enough to trigger a sell-off. The second issue is the international stagnation we already discussed. 8% growth in international commercial is a flashing yellow light for any investor who needs this to be a global growth story. And the third issue came directly from the CFO, David Glazer, who confirmed on the earnings call that operating expenses will ramp meaningfully throughout 2026. They are spending aggressively on product development pipelines and elite technical talent to stay ahead of the AI competition. At a valuation of 110 to 150 times forward earnings, any confirmed increase in spending is immediately viewed as a threat to the margin profile that justifies the premium. But here is the critical counterpoint. Management did not just absorb these critiques. They went on offense. Management did not just beat and walk away. They raised their entire forward outlook. Full year 2026 revenue guidance was upgraded to a range of $7,650 million to $7,660 million, implying approximately 71% full year growth. They are projecting United States commercial revenue to grow at least 120% for the full calendar year, and they revised their adjusted free cash flow guidance upward to between $4,200 million and $4,400 million. That is management telling the market clearly and directly, we are not decelerating, we are becoming significantly more profitable than you were modeling, and we are betting on ourselves aggressively. Reconciling that message of confident forward momentum with a stock that has been under persistent selling pressure creates a genuine and fascinating dissonance. And nowhere is that dissonance more visible than in the split between the professional analysts who follow this stock most closely. On one side, you have Dan Ives at Wedbush with an outperform rating and a price target of $230. He calls Palantir the software layer of the artificial intelligence revolution and argues that their defense and government dominance represents a structural competitive advantage that competitors simply cannot replicate quickly. On the other side, you have HSBC sitting at a hold rating with a target of $151, warning that OpenAI and Anthropic are moving quickly to replicate the engineer-heavy deployment model that Palantir has built over years. Could a large language model provider genuinely replicate Palantir's decade of embedded government relationships and classified system integrations within the next 2 years? Almost certainly not, but the debate is real, it is live, and it is actively driving institutional positioning. The broad analyst consensus sits at a moderate buy across 31 analysts, with an average price target of $195, representing roughly 32% upside from current levels. But there is one additional signal worth noting, not from the analysts, but from the people inside the building. Net insider activity during this record-breaking quarter shows 0 purchases. Every insider transaction recorded was a sale. Insiders sell for many legitimate reasons: taxes, diversification, pre-planned trading schedules, but the complete absence of any buying from people with full information access does suggest that those closest to the business consider the current valuation stretched, even with the strong execution. The options market is sending equally important signals. Implied volatility is running at 115%, which means the market is pricing in a potential swing of roughly 10% or more in either direction over the coming week. But within that volatility, 2 enormous positioning walls define the near-term range. There is a call wall sitting at $160, acting as heavy overhead resistance. And there is a put wall sitting between $130 and $135, providing a substantial stabilizing floor on the downside. The smart money appears to be betting that Palantir stays trapped inside these 2 boundaries for the foreseeable future, at least until a clear macro catalyst resolves the uncertainty. Looking at the technical structure, the chart is telling a cautionary tale. A descending triangle pattern is forming, lower highs pressing consistently downward against a horizontal support zone. The critical line that bulls absolutely must defend is the 200-day moving average, currently at $143.26. Palantir is hovering directly on top of this level right now. The relative strength index sits at 58.9, not in overbought territory, but also lacking the explosive momentum that would be needed to break convincingly through that descending resistance. If the 200-day moving average fails as support, the next meaningful destination is that $130 put wall. For anyone thinking about positioning, the setup is fairly clear. Do not chase the spike. Wait for a successful retest of the $143 to $144 zone that confirms the 200-day average is holding as support. Immediate support sits at 142 and 130. Resistance levels above are 155 and then that major 160 call wall. A drift toward 160 is plausible over the next 3 months if geopolitical tensions ease and macro conditions stabilize. The 12-month target range of $195 to $210 remains in play, but it requires them to actually deliver on the upgraded 2026 guidance they just put in front of the market. And that brings us to the bottom line. Palantir is genuinely a one-of-one execution story right now. First quarter 2026 proved definitively that they can monetize artificial intelligence at a scale their software peers have not come close to matching. But their triple-digit forward valuation turns every earnings print into a high-stakes referendum. To stay confidently bullish, you need to track 2 things above all else: the United States commercial customer count, currently sitting at 615, and the durability of the United States government growth, particularly around defense contracts like Maven. If those 2 metrics hold and accelerate, the bulls have a very strong case. If either cracks, the valuation has nowhere to hide. Now, before I wrap up, I do want to be completely transparent with you. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything we discuss today is purely for educational and informational purposes. Always do your own research, consult a qualified financial professional, and never make investment decisions based solely on any single content source, including this channel. Your financial situation is unique, and you deserve guidance tailored specifically to you. With that said, this is genuinely one of the most fascinating stock stories in the entire market right now, and I want to hear where you stand. Here is my question for you in the comments. If Palantir delivers on its full year 2026 guidance and United States commercial keeps growing above 100%, but international commercial stays stuck in single digits, is the long-term bull case still intact? Drop your answer below, because I genuinely read every single comment, and the conversations in this community are some of the smartest on the platform. If this breakdown added value to your investing process today, please hit the like button. It genuinely helps more people find this content, and it tells me you want more deep dive earnings analysis like this. And if you are not subscribed yet, now is the time. We do this level of breakdown every single week on the stocks that actually matter. And if you really want to support the growth of Smart Stock Sam, you can send a super thanks right here on YouTube. Every single one of those goes directly into making this content better and more detailed for you. Until next time, stay sharp, stay patient, and as always, invest smart.